Okay, so coming to efficiency ratios, what does efficiency ratio talk about is how efficiently are you able to manage your working capital within the company? Not just working capital, how efficiently are you able to manage your business? Mostly working capital, but also entire assets. So how will we know the efficiency? In the working capital, we get the information about efficiency when we get to see how fast are we able to turn our operating cycles within the entity. Okay, like if we are able to turn over the working capital more number of times, so every time a working capital is turnover, right? You imagine like this: you got funding from your shareholders or debt holders. You use that money to buy material. You spent on it direct expenses. Then you added profit to it and you sold it to the customer. You waited for the customer to pay you cash. Once that cash came back to you, that's the one cycle. Okay. In one cycle, what you earned is the profit component which you had added at the point of sales. So one time it rotates, you get one time profit. The more number of times it rotates within a year, more is your profit. So the faster and the higher number of times the operating cycle keeps or working capital cycle keeps moving within the year, more efficient you are. Okay. So when we say operating cycle has to move fast, how do we determine operating cycle? It comes from these days. How many days did you hold your inventory? How many days did you hold your receivables? How many days could you hold your payables? And like this. So let's move into it. Let's get into it and look at the formulas for each of the ratio. To start with, we'll say receivable days. So what is this ratio about? Let's look at in this Excel. So what does receivable days talk about is your average receivable. I have only 1 year financials here, so there's no average. But if you are, let's say if you have previous year figures as well, you can take simple average of those two numbers. Okay. For now, I am considering this as average. So this is your average receivable, and this is your credit sales. I am assuming all the sales are on credit. Okay. This is your credit sales. So I want to find out these receivables corresponds to how many days worth of credit sales. So how do I get it? That is, if I divide this by this, I get a percentage, which is 3%. Okay. So if a year is of 360 days and 3% of it is stuck in the receivables, which means 11 days worth of 10.8 days worth of debtors are stuck in the working capital. Okay. The other way to look at it is if I take this sales, if I divide it by 360, which means we get uh, sales per day. Okay, this divided by 360. This is sales per day. Okay. And if I divide the receivables with the sales per day, we get 10.8 again. So 10.8 worth of sales, days of sales is remaining as receivables in our balance sheet. That's what this ratio talks about. Okay. Next comes payable days. Just a sec. Hmm. Okay. There's some issue in sharing the screen. Okay, fine. So let's get back to payable days. When we talk about payable days, again, the logic remains the same. Let's say our purchases is this entire purchase is credit purchase, and our payables is this amount. So if we see what percentage of it is outstanding, it is 4.37%. If a year is of 360 days, you can take 365 as well, depends on what the question states. If I multiply this with 4.37, I get 15.74 days, which means out of the entire purchases that we make during the year, 15.74%, 15.74 days worth of purchase remains as payable in my books of accounts. Okay. So based on this, the formula can be derived, right? This is the formula. We took average payables divided by credit purchases into 365. Similarly for accounts receivable as well, the receivable days as well. Then comes inventory days. Inventory days is also on similar lines, but the logic here is when we were taking receivable days, we took sales as the base. When we took accounts payable, we took purchases as the base. But when we are looking at inventory, we will take cost of goods sold, cost of goods sold as the base. Okay. Here, not just purchases, we also have direct expenses. Okay. Why? Because if you remember the accounting standards IFRS 2, which is sorry, IAS 2, which is how do you value your inventory? It takes purchase cost, it also adds direct cost into it, right? So the value of the inventory here, this includes not only the purchase cost, it also includes the direct expenses. So if this includes direct expenses, the base which you are taking should also include direct expenses, and that is COGS. So if your COGS for the year is 900,000 and your average inventory is 45,000, if you take a percentage here, it is 5%. Okay. And if you take this 360 days into 5%, it gives you 18 days, which means out of this total cost of goods sold during the year, 18 days worth of cost of goods sold is lying here as inventory in your balance sheet. This is what the ratio talks about. Okay. Getting back to the PPT. Mm, okay. So we looked at these three ratios in terms of number of days, but it's not necessary to look at it at number of days only. We can also look at it as in terms of times. How many times did the receivables turn over and over again within the business? Like this is the credit sales, and this is the average receivables that we had. Okay. So if I divide this by this, it's a 33.33%, which means in plain language, we can say that, business language, we can say that the receivables were turned over and over again within the business 33 times during the year. So the operating cycle, which I was talking about, that happened for 33 times in terms of uh, receivables. Similarly, for payables, if this is the purchases and these are the payables, if I divide this by this, we get 22.8 times. Similarly, for inventory again, if I take cost of goods sold and if I take inventory here, if I divide this by this, we get 22.5 times the inventory turned over and over within the year. Okay. So the same ratios which we calculated in terms of days, we also did it in number of times. Okay. Now, if you remember, we spoke about the conversion cycle and I said we will look at it at later stage. Now you know how to calculate the number of days of receivables. So the operating cycle or the conversion cycle is receivable days plus the inventory days minus the payable days. What the number of days that you receive, you get is the number of days it takes for the cash to turn entirely within the business and come back into the form of cash again. So that ratio talks about operating cycle, number of operating cycles within a year. Okay. Okay. So next is financing ratios. In financing ratio, we'll look at gearing ratio, interest coverage, and long-term solvency. We'll get into the details now. The first one is gearing ratio. Okay. So when we say gearing, what does it mean? It means it is used for checking the ratio of the long-term debts compared with the equity. Okay. Now there is two way of looking at the gearing ratio. Okay. So just a sec. Okay. So gearing ratio is also known as leverage ratio. Okay. So when we say leverage, it comes from the word lever. Okay. Lever is this. If you look at this image, it will be easy for you to understand. So this is a lever. Okay. This stick is called lever and it is used to lift heavy weight objects here. This setup is called lever. If we look at the financial management in terms of this image for the gearing ratio or the leverage ratio, what we see is the pink portion here is the equity and the yellow portion here is the debt. Okay. So when you will learn the cost of capital, you will understand that the cost of debt is smaller than the cost of equity because the risk that the equity holders take is higher compared to the risk that the debt holders take. So obviously the returns which the debt holders get is low, so the cost of debt is low, which means if a company wants to maximize their profits, logically they should have more and more of debt so that the cost of capital is low. Okay. But does that mean they can expand their debt to any levels? No, it doesn't mean that. Just like in this scenario, okay, if you look at this yellow portion, the long portion is on the left hand side and the short portion is on the right hand side. Now, if you have ever done this in your life when we were small, some might have done it. The longer is the portion on the left hand side, easier it is to lift the weight. But it doesn't mean you can take it all the way towards the left. If you do that, then it won't work. There is certain equilibrium point in between, wherein beyond this point, if you move further left, the lever won't work efficiently. So that point is the point where you have to stop, as in the ratio where the debt has to stop and the equity has to be given preference for. Okay, so this is how we look at the leverage ratio. Now, what does the leverage ratio actually mean here? So when we take ratio of this yellow divided by pink, that is one way to look at the gearing ratio. That is debt divided by equity. The other way to look at it is yellow divided by the entire stick, that is yellow plus pink. So both these formulas are right. They can be used depending on what you are trying to find. And as far as I understand, the question would specify what it is about. And if it doesn't specify, then then I think if it is in percentage terms, like leverage ratio is 70%, it means Debt divided by total is 70%, which means out of the total stake, 70% is the debt. This is how it can be interpreted. So yeah, so the leverage formula is leverage ratio or gearing ratio formula is two types. Number one, this yellow portion, that is debt divided by equity, which is also known as debt to equity ratio. Number two, it is debt divided by the total capital, that is yellow divided by the entire stake. Okay, getting back here. So that's what is mentioned here, comparing the long-term debt with equity or checking the proportion of the financial risk. It helps to identify capital structure that is appropriately leveraged or not. Okay, next is interest coverage. Okay, we have the word coverage here. So as I said, when we look at the word cover or coverage, we will imagine it like this. Interest coverage. So how much is the profit and what is the interest that you have to pay? So if you use this profit to pay the interest, how many times can you pay the interest? That's the answer you get when you find the interest coverage. Like in this Excel, what is the profit just before paying interest? Here we are paying interest, and this is the profit just before interest. So if I ask you how many times can you pay interest out of this profit? So I will take this divided by this, put minus sign. Okay, so we get 35 times. Okay, which means with this profit what we are earning, we can pay interest 35 times, which is way too high than a regular one, which means the company is in a very healthy position. The financial risk for this company is very low. Ideal ratio is 3. Up to 3, it is considered a good company. If it falls below 3, then there's a caution that to be cautiously to be looked at. And if it goes below 1, which means your profit is not even able to service your interest, company is doomed. So that's how you interpret this interest coverage ratio. Then comes the long term solvency ratio. So it talks about in long term, does your company has enough funds to pay all your external borrowings or not? Okay, if the company is having a risk of getting into bankruptcy, so when will that happen? When will that happen is again the same thing which I spoke about. If your profit which you are earning is not even able to sufficiently pay your interest, which means this ratio, if it goes below 1, then there's a problem for the company. In the longer term, it's not even able to pay the interest, it will not even be able to pay the principal, of course. Okay, now comes the investment ratios. These are the ratios referred by the investors when they make decisions on whether to invest in certain company or not. Okay, so starting with dividend payout ratio. So as we looked at this Excel sheet, profit and loss statement, at this stage, the profit belonged to preference and equity. After this, we paid preference dividend. Then what remains is entirely for the equity shareholders. Okay, this is profit available for equity shareholders. Out of this, the company decides to pay dividend of 45,000. So question is how much percentage of this is distributed as dividend? So this is the dividend distributed out of the total available profit of this. So if we take a ratio here, this gives us 23%. So we say dividend payout ratio is 23%, which means 23% of the profits which the company has earned, 23% of it is distributed as dividends for the owners of the shareholders of the company. So this dividend ratio talks about percentage of available profit for shareholders, which is distributed as dividends, not profit, dividend. Typo error. Uh, why is it used? To look at the intention of the company. So when the investors look at this ratio, they get to know the intention of the management. What is the management planning? If let's say a company is having large dividend payout ratio, which means it generally happens in a very stable large organizations uh, which has grown huge, and whatever profit it is earning, it is issuing as dividend, and it is not retaining much profit. There's no uh, plans for expansion or something. So whatever profits are coming, they distribute as dividend. But if company has a plan to expand the capacity or start new business in new location, they need funds. They will not distribute the dividends, the entire profit as dividend. They will hold back some retained profits. So the investors, when they look at this ratio, they get to know what is the mindset of the management in this company. Are they looking to be in a stable manner, or are they looking to expand, or what it is? Formula. Here we took it as a whole P&L number. If we divide this both number by the number of shares, we can do it as per share as well. Like let's say if this company has total uh, 500,000 shares, okay, no, 50,000 shares. So if we divide this by 50,000, what we get is dividend per share. If we divide this by 50,000, what we get is earnings per share. And if we take ratio of this, the percentage remains the same, 23%. So the formula is dividend per share divided by earnings per share into 100. Okay. So next is dividend cover ratio. So coverage ratio. Again, the word cover comes, the coverage comes. We will again look at it like this. Out of the available profits for the shareholders, let's say if you want to distribute the entire amount as dividend, how many times dividend can you pay? Okay, so it's like if we go to this sheet again, so the total profits available for shareholder was this 3.9, and out of that we distributed zero point 0.9 as dividend. How many times can we issue this dividend? 4.33 times. So if it is planned to issue all this profit as dividend, we can issue 4.3 times the dividend. That's what this ratio talks about. Why is it used? It's used to see the capacity, how, as in, not all investors are looking for the company to expand. Okay, some like retired, if you have, if you are retired and you have your pension funds. So what your idea would be to invest in the shares which keeps giving you regular dividends to keep up with your daily routine expenses. So not all investors have same mindset. Some are focused on dividends, some are focused on growth. So this ratios, which is relevant to dividends, are mostly important for the ones who are focusing on dividends. So this ratio particularly talks about the capacity of the company and possibility of the company giving dividends. The higher the ratio, the better is the capacity. Okay. So dividend yield ratio. There are few typos you can ignore. Dividend yield ratio. Okay. So when we say dividend yield, okay, it means if we are getting a dividend of zero point 0.9 today, and if we go to market to buy this share, let's say, and if share costs 5, so the question to ask is, if we keep getting this zero point 0.9 as dividend, how many years will it take for us to get this amount back? So it's like 5 divided by 0.9. It will take 5.56 years or 5.56 times of dividend to get a payback of our current market price. Current market price, dividend per share. So what's the formula? Current market price divided by the dividend per share is the number of times that you need dividends to get repay the entire amount, or uh, yeah, 5.6 times of dividend you will need to get the entire amount back. That's what this ratio talks about. Now this is also in terms of this in terms of when we talk in terms of times, it becomes PE ratio. This, but when we talk in terms of percentage, it becomes dividend yield ratio. Okay, so how do we do it in percentage terms? Dividend divided by market price. We say if we buy shares for 5 and we get 9.9 as dividend, we say 18% is the dividend yield. And in other words, we say it will take 5.56 years to get a repayment of the entire amount. So this ratio is called dividend yield, and this ratio is called price to earning ratio. Price is how many times of earnings? 5.56 times. What is the yield? We get 18% return of if we invest in the shares today. We get this as dividend. So these two ratios are covered. Next is earnings per share. Now earnings per share is of two types: basic earning per share and diluted earnings per share. First look at basics one. So we can delete all of this. So we have this profit available for shareholders. Okay. So this is the earnings available for shareholder. If I divide this by the number of shares, sorry, this is, so we get earnings per share 3.9, and this is a basic earning per share. Okay. So which means in this year, the earnings that the company has made it equivalent to 3.9 per shareholder, per share. Now, in this example, we do not have a borrowings which are in convertible nature. But let's say, for example, if these debentures are convertible debentures. So, what will happen is in next year, let's say these are going to get converted into equity shares. So, looking at this ratio in this year, you'll see 3.9, and the investors will make future decisions based on this number. But in future won't be similar like this because your debt is going to get converted into equity. So investors should be well informed about this. How to do that is to show them the diluted EPS. What does that mean? It means we take this profit and we adjust this profit so that we remove this interest, because once this debt gets converted into equity, you don't have to pay interest to them, right? So the interest saving that you make here is adjusted in this profit. Then that, since your interest will go off, you will have to pay more tax. So that tax is adjusted in this profit, and your equity shares will increase. When these debt will get converted into equity, your number of shares will increase. So in this formula, or form in this ratio, simple earnings per share ratio, basic earnings per share ratio, we took profits available to shareholders divided by number of shares. Now both are changing. Adjusted profit for shareholders divided by adjusted number of shares. This will give you diluted earnings per share. Most probably, this won't be a part of exam because calculation is a bit tricky here. It depends on many factors, as in how many numbers of shares this debt will get converted into, at what rate, all that comes into play. So I'm not getting into that detail, but the logic behind the diluted EPS is here. Adjusting this profit, considering as if the debt is already converted into equity. So this profit will change due to the interest and tax, and this number of shares will change due to this conversion. Changing both these numbers, when we divide it, we get earnings per share, which is diluted. Okay, getting back here, we discussed basic EPS, diluted EPS, price to earnings is already done. Now all the ratios are considered. Okay, if we go back to the first slide here, we consider profitability, we did liquidity, we did financing, we did efficiency and investment. All five categories of the ratios are considered. Ratios is explained, formula explained, logic you might have understood. Now use this logic to solve the question, and if you get any queries, get back to me. We'll solve it together then. And if you will suggest one good question that you think I should solve, then let me know. I can do that as well. See you with the next topic, which will be cost of capital probably. Thank you. Bye bye.